featuring today Jesse Felder. You may know of him, Wall Street guy, successful hedge fund manager, and Warren Buffett. We're going to be talking about things that Warren Buffett is doing, and we're going to be talking about things that Jesse Felder is seeing with consumer demand, spending, the market, economy, etc. Hi, I'm Ben Reppond. Welcome to my YouTube broadcast. Today is October 1st, 2024. I'm going to start with Jesse Felder. He started with Bear Stearns a long time ago, and then started his own hedge fund, which became a multi-billion-dollar hedge fund, very successful. And then now he is transitioned over to writing his research called the Felder Report. And he's being interviewed by Adam Taggart, and some interesting insights. I'll play the clip for you, but it's about the concept that the economy is slowing. And it is slowing to the point where I'm not saying it's going to crash, maybe it will, but it is slowing. And so what's happening is as consumers become more concerned about the slowing economy, and maybe they're losing their jobs or will lose their jobs, then they're holding back on spending. As they hold back on spending, the consequence of that is lower corporate earnings. And lower corporate earnings means a declining economy and a declining stock market. And then it becomes a vicious cycle. And he articulates that. He refers to former Fed President Bill Dudley and his comments about where we are, based on history, where we are in the economic cycle. There are lots of indicators on how money is moving in the stock market and bond market. The market has been moving in the last 2 months, as he says, and gives information on it, in a more defensive direction. So the defensive stocks or defensive sectors have become more in favor than the traditional growth stocks. And these are definitive indicators of a slowing economy. So take a listen to Adam Taggart and Jesse Felder.
So, he talks about how, right, people start to fear for losing their jobs. They start to spend less. That puts pressure on corporate profits. So hiring goes down, and it just kind of becomes a vicious cycle. In his latest piece, came out yesterday, he suggests that he thinks the labor market's either crossed this tipping point or we're rapidly approaching it. So this has already become a self-reinforcing deterioration in the labor market. And I think that's probably the best estimation of where we are right now, is that things haven't deteriorated enough, perhaps to decisively say, yes, we're in recession, or recession's going to start in the next month or two. But it looks like we're rapidly heading in that direction. And the idea that things are just going to stop, and kind of flatten out, is against what we've seen historically, which is once these things start to turn, they continue in that direction. And I think there's tons of data to support the idea that the labor market is deteriorating in a significant way. I think, we've seen the unemployment rate tick up, but I think people really didn't pay much attention to the latest Challenger Grain Christmas report that showed job cuts in August hit the highest level for any August going back to 2009. More importantly, I think job hires, new announcements of hiring, were the lowest level year to date that the firm has ever recorded. So the labor market, and that's back to 2005. So firms are hiring less than they have done in 2 decades. The labor market's rapidly weakening, and we're seeing that start to kind of materialize in things like consumer spending. So I think we have come to the point where we've fully priced in a soft landing in the stock market. And now what we've seen over the last couple of months with the heightened volatility of things, the market may be going, wait a second, maybe a soft landing isn't, pricing 100% probability of soft landing was not such a smart idea, and having to kind of reconcile with the fact that it might not be so soft after all. it's interesting to me to see the stock market begin to validate the idea that, we're maybe not headed for a soft landing. When you see utilities outperform the NASDAQ, when you see gold prices outperform the NASDAQ, and you see all these defensive stocks, Costco, outperforming the rest of the stocks in the QQQ, Walmart, outperforming. These are all signs within the stock market that, with defensives outperforming dramatically over the last couple of months, that something is changing, and the stock market is trying to price a different outcome than a soft landing. And the bond market has been pointing in this direction for a while, right? Bond market is, with the 2-year yield and expectations for Fed rate cuts over the next 12 months, bond market is screaming recession right now. And so, there's been a disconnect between stocks and bonds, but I think stock market is coming around to the idea that the bond market is right on the money here. And I would just point out things, in terms of consumer spending. Francois Trahan has pointed out that the restaurant performance index has plunged in a way that we haven't seen outside a recession. We've seen Ally Financial recently, big used car lender, talk about how they've seen rising defaults and delinquencies over the last couple of months. These are like real-time indicators, July and August, higher than they expected. And people are not just blaming cost of living now, they're blaming rising unemployment. And so this is a sign that this self-reinforcing deterioration in the labor market that Bill Dudley is kind of warning about is actually happening. And so I think it's, to me, especially interesting to see the stock market start to price this in.
Okay, a piece that that Jesse Felder referred to is this Fed chart on unemployment. You can actually find it on the St. Louis Fed website and on unemployment rate. What I thought was, and I didn't play it for you, I wanted to show it to you. What's interesting about this to me is that when you look at the stock market will typically go up and up and up in a gradual way and then precipitously decline, a sharp decline, and then it repeats itself. This is the opposite. So unemployment is inversely correlated to the market. So what happens is unemployment comes down and down and down, which means employment goes up, and then all of a sudden, for some reason, unemployment shoots up in a manner like that, and then it repeats itself. The stock market, is approximately inversely correlated to this. I just thought it was interesting because I'm so used to looking at the inverse of this that I thought this was so interesting. And of course, to the far right, what you see was COVID, the COVID-19 crisis at the very end, where unemployment shot way up and then actually didn't just gradually decline, it came down very quickly because of the uniqueness of what happened with COVID. Okay, now I want to play a piece and talk about this concept of what's going on with Warren Buffett. I'll say this at the beginning. I mean, he's the biggest name in investing probably in the world. He's 94 years old. He has been very successful for, I don't know how long, 50, 60, 70 years, a long, long time. And he's followed a particular mantra of saving his money, buying value stocks at a deep discount. Value stocks, deep discount. And then he rides it up. What he has done over time, and I think he's doing it even more now, is he's starting to sell assets, certain assets. And what he's doing is accumulating cash. He has done this in the past. He's accumulated cash not just from earnings, but from selling certain stocks that he feels are at a point of being risky. At this point, the thing that is most risky for him, that the ones he sold the most, are Bank of America and Apple stock. He sold large positions in them, resulting in huge amounts of money that he has been able to accumulate. So he's gone from 100 billion in cash, 150, now he's at $277,000 of cash. Maybe it's sitting in treasuries or something like that. getting a small rate of return. And his investors, some of them are sympathetic with his position because they understand his style. Some are less so, where they are saying, come on, invest our money. The market is going up and up and up. And Warren Buffett, in all of his wisdom, is saying, not so fast. I know what's coming. And what he believes is coming is a deep decline. Maybe it's a recession. Maybe it's a decline in the market of 20, 30% or more, but he's looking for better prices. So he's done this many times, and he's lost a lot of money uh, during these deep declines for the stock he has retained, because he does retain most of his stock, but he puts a portion on the sideline so that he can have it available to take advantage of bargains when they occur. And I've said this before, and people sometimes don't agree with me, but uh, Warren Buffett is the ultimate market timer. I mean, he's looking at macro cycles, accumulating money, buying at deep discounts, writing it up, selling again, and repeating the cycle. So he doesn't portray himself as a market timer, but I can tell you he is not a typical buy and hold investor. Buy and hold investors leave all their money invested, write it all the way down with all their money, and then write it all the way back up. What he's doing is more tactical, which is somewhat market timing. Now, a good portion of his money is strategic and is buy and hold, so I acknowledge that. But he's looking, in order to make money in the market, in my opinion, you have to be tactical. In other words, you have to get out of positions when they become out of favor, get back in at a better time when they become more in favor. And if you're a value buyer or a growth buyer, depends on what method you use. I am definitely tactical. I do not like the idea of holding all my positions, have them ride all the way down, and then gradually over many years ride back up to eventually get back to where you started. I don't, just personally, I don't believe in it. I know a lot of people do. A lot of people use advisors who believe that way. But if you do that, or advisors who recommend that approach, it's in my opinion, a very unsatisfactory, disappointing, and frustrating experience. But Warren Buffett is doing it. So he's sitting on 277 billion, waiting for a better opportunity. And if he's saying this, he has some kind of indication. He must have some kind of indication about the direction of the market. I think he believes by doing this that we are not that far away from a deep decline. You can call it a crash, a collapse, whatever, but why would he sell now something like Bank of America and Apple, two, in my opinion, two good companies? It's because those are the ones that are probably likely to get hit the most, and we're not that far away from it, just an opinion. So this was a piece, I'm showing you a clip here from CNBC, and now I will play a clip from him describing what he sees coming. So take a listen.
However, today, Berkshire has been in the news for different reasons. The firm has recently reduced its stakes in companies like Apple and Bank of America. Since July, Berkshire has offloaded 116 million shares of Bank of America. In addition, Buffett also reduced Berkshire's stake in Apple by over 50% earlier this year. It has sold more than 116 million shares of the iPhone maker. These sales have pushed Berkshire Hathaway's cash reserves to a record $277 billion, up from $189 billion just 3 months ago. Some experts say that these sales reflect Buffett's cautious approach amid the current market conditions. The US economy has been cooling down over the past few quarters. The Federal Reserve has raised interest rates to a decade high to fight inflation. Recently, some market watchers have raised alarms that the country may fall into a recession. In such a scenario, Berkshire Hathaway's cash reserves would serve as a fortress.
Now, having ended with Warren Buffett, I was looking for something I could share with you. So I kind of searched around and I found a quote by his partner, Charlie Munger. And Charlie Munger's probably his quotes are as good or better than Warren Buffett's. Knowing what you don't know is more useful than being brilliant. Think about it. Thank you for watching. If you have questions or comments, leave them in the comment section below.